Good morning everyone. Welcome to another episode of the Mizuho Week Ahead. I'm Boon Heng, market economist at Mizuho Bank. This week's theme is flipping correlations, delayed plans, and falling projectiles. A seemingly supportive backdrop of lower oil prices, driven by sight of oil flows via the Strait of Hormuz, failed to steady nerves. Risk sentiments were blunted by continued worries around AI capex spending as tech stocks led declines despite lower USD yields last week. With SpaceX declining 70% last week, the softer risk sentiments translated into caution for IPOs in the pipeline, with OpenAI being advised to delay going public. Elsewhere, price increases announced by Apple and Microsoft for their hard products also reflect the adverse spillovers of higher demand for semiconductors and electronic components. Even as price hikes serve to alleviate margin wounds from higher costs, the risk is shifting towards demand resilience. The worries are not unfounded, with US Q1 consumption being revised lower in the latest print, even before the full impact of higher energy prices weighed. On the conflict front, US refuting attempts by Iran to impose tolls is not surprising, though the end of last week's worry was the sight of tankers turning back after being warned by the IRGC that alternative routes to Iran-approved ones are highly dangerous and prohibited. The alternative routes were being coordinated with US and Oman. Sight of a container cargo ship being hit by an unknown projectile worsened these worries. US and Iran continued the trade strikes over the weekend. Notably, with talks between US and Iran set to be held on Tuesday in Qatar, it has been reported that these attacks will be halted, in turn backstopping risk sentiments for this morning. On monetary policy, even as Fed officials continue to express discomfort on inflation, rate hike expectations were pared back as New York Fed President Williams said interest rates were well positioned to bring inflation back to target. With PCE prices last week coming in as expected, two-way volatility on rates will persist. In Japan, BOJ officials sounded hawkish, with calls for regular rate hikes every few months towards 2%. That said, yen weakness continued, and that is exacerbating intervention risks amid jaw moaning by Finance Minister Katayama. In Korea, the MSCI kept Korea in the Emerging Markets Index amid various operational barriers which needed further reforms. The lack of an upgrade into the Developed Markets Index added onto Korean won woes from persistent foreign outflow from equities last week. In Indonesia, the rupiah continued to slip, despite MSCI extending their review to evaluate reforms undertaken by the authorities, and that in turn averted a near-term downgrade. Both the Aussie dollar and the Thai baht underperformed last week, the Aussie dollar being weighed down by wobbly risk sentiments and falling metal and energy prices. Meanwhile, the Thai baht was dragged by falling gold prices. Looking ahead, Vietnam's economic data releases are likely to retain an optimistic note, with Q2 GDP growth likely being very buoyant. Amid the continued efforts to boost growth via the SBV's moral suasion to lower lending rates and efforts to raise credit ratio, overheating risks in Vietnam ought to be watched for, especially if inflation continues to be above the SBV's target in recent months. In Malaysia, even as the ringgit rebounded to outperform last week, domestic political uncertainties may be imparting a risk premium in the near term, subjecting the near-term ringgit recovery to fits and starts. For the upcoming data releases, the US non-farm payrolls will fall a day earlier on Thursday, as Friday is the observed federal holiday for Independence Day in the US. Markets will have to assess the durability of World Cup-induced hiring boosts in what is expected to be a buoyant jobs NFP print. All in, both ascents and descents are far from being controlled. Leverage risks in North Asia are inciting wild swings in equities even amid a firm semiconductor cycle, compounding onto dire performance of EM Asia FX that has seen little relief despite lower oil prices and USD yields. In short, correlations and conditions are not as stable as assumed, and adjustments are far from being smooth. For more information, please refer to our week ahead publication or contact your respective sales desk and RMs. And for regular notification on our market views, please subscribe to our channel and hit the notification button. Thank you.